Right now, while you are tracking the same 10 stocks that everybody else is tracking, something is occurring beneath the surface of this market that almost no retail investor comprehends. Money is moving not out of the market but into specific parts of it quietly, systematically, in the way that institutional capital always moves before a major repricing becomes apparent to the public. And by the time it becomes apparent, the opportunity will have largely closed. I want to show you precisely where it is going, why it is going there, and the 3 specific companies that are sitting at the intersection of the structural forces driving that flow. But before I do, I need to explain something about how the market actually functions. Something that most investors have never been told, because without understanding it, the rest of what I am about to say will not land the way it needs to. The S&P 500 is not what most people believe it is. It presents itself as a diversified basket of 500 American companies. In reality, 10 companies currently represent approximately 40% of the entire index. The other 490 companies share the remaining 60%. This concentration, the highest since 1972, which is not a coincidence, I will explain shortly, is the product of something called market cap weighting. The larger a company is, the more of the index it represents. And the more money flows into passive index funds, the more automatically and mechanically that money is directed toward the largest companies. U.S. exchange-traded funds now hold approximately $13 trillion in assets. Every dollar of that flows disproportionately into the same 10 names. The practical consequence is this. If you are holding an S&P 500 index fund, you are not holding a diversified portfolio. You are holding a highly concentrated bet on 10 mega-cap technology companies wrapped in the language of diversification. And when those 10 companies are thriving, when their earnings are expanding, when the macro environment favors them, that concentration works in your favor. But when the macro environment shifts against them, the concentration becomes a trap. The same passive flows that push them higher will mechanically push them lower. And the investors who recognized that the concentration was a risk and who had already rotated into the sectors receiving the next wave of institutional capital will be the ones who outperform. While the index treads water, here is the part most people miss. The macro environment has shifted, and the sectors that benefit from the new environment are not the ones that benefited from the previous one. Let me explain what I mean by that, because the mechanism is important. In 2021, everything rose. Interest rates were near zero. Liquidity was abundant. The discount rate applied to future earnings was essentially negligible, which meant that technology companies with earnings weighted heavily toward the distant future were disproportionately valued relative to companies generating earnings in the present. Buying the index was sufficient. Sector selection was irrelevant. The macro weather was uniformly favorable for every asset class simultaneously. That environment no longer exists. Inflation is running above 4% by the OECD's most recent forecast. The Federal Reserve is operationally constrained in a way it has not been since the stagflationary 1970s. It cannot cut rates aggressively without risking an inflation acceleration. And it cannot raise rates to control inflation without risking a growth slowdown that the current fiscal situation makes particularly dangerous. Oil prices are structurally elevated due to geopolitical disruption of the world's most critical energy corridors. And the government is spending money it does not have at a rate that historically has preceded currency debasement. In this environment, what you own matters more than when you own it. The sectors that have structural tailwinds from the new macro conditions will significantly outperform those that do not, regardless of what the headline index does. This is not theory. In 2022, when the S&P fell 15%, energy, infrastructure, and defense stocks delivered returns of 30 to 50%. The money did not leave the market. It rotated, and the investors who understood the rotation captured those returns, while investors holding the index experienced losses. The question worth asking, and I will answer it specifically, is where the rotation is heading. Now, there is a framework I have used across every market cycle I have navigated, and it begins with a discipline that most retail investors never apply. You do not start with stocks. You start with the macro environment, move to the sectors that benefit from it, and only then identify the specific companies within those sectors that are best positioned to capture the tailwind. The sequencing matters because starting with stocks, which is what almost every retail investor does, means making decisions in a vacuum. You are evaluating a company without knowing whether the sector it belongs to is currently receiving or losing institutional capital. That is like analyzing a vessel without knowing which direction the current is flowing. The macro environment I just described, energy scarcity, inflation persistence, geopolitical supply chain disruption, domestic manufacturing imperatives, AI infrastructure build-out points to 2 specific sectors with unusual clarity. And within those sectors, 3 specific companies where the capital flow data, the fundamental earnings trajectory, and the technical evidence of institutional accumulation are all aligned simultaneously. The first sector is energy infrastructure. And I want to be precise about the distinction between the obvious trade and the real trade here because they are not the same thing. The obvious trade buying oil producers when oil prices are elevated has already occurred. The exploration and production companies spiked in the initial phase of the geopolitical disruption driven by fear and by algorithmic systems buying the immediately obvious thesis. Institutions were largely already positioned when that spike occurred. They were not buyers of the spike. They were in many cases sellers into it. That initial move was sentiment-driven. It was not the beginning of a structural allocation. The real trade is the picks and shovels, the companies that supply the equipment, the machinery, the infrastructure, and the services that make energy production possible. These companies benefit from elevated energy prices, which make additional production and infrastructure investment economically justified, but they are not directly exposed to the daily volatility of the oil price itself. Their revenues come from long-term contracts, from infrastructure build-out programs that take years to complete, from the sustained capital expenditure of energy producers who need their equipment and services, regardless of short-term price fluctuations. And here is where the current setup becomes structurally unusual in a way that has no direct precedent in recent history. The AI build-out is creating an energy demand surge of a scale that the existing infrastructure was not designed to accommodate. Data centers running large language model inference and training consume extraordinary amounts of power. The grid infrastructure connecting that power to where it is needed is inadequate and requires sustained multi-year capital investment. The natural gas processing, transportation, and export infrastructure that provides a significant portion of that power is operating at or near capacity. Every one of those constraints is a multi-year investment cycle. Every one of those investment cycles flows through the balance sheets of the energy infrastructure and machinery companies. The specific name I am monitoring most closely in this space is Baker Hughes, ticker BKR. This is one of the world's largest oil field services companies, a company whose most recent earnings specifically flagged that the geopolitical disruption to Gulf shipping could persist through the end of the year, and whose backlog includes active development of offshore LNG terminal infrastructure in Texas. The fundamental thesis is straightforward. When the world needs more energy infrastructure, Baker Hughes constructs it. When oil prices are elevated, the economics of building that infrastructure improve. When geopolitical disruption creates new demand for alternative supply routes, the volume of projects in their pipeline expands. All three conditions are simultaneously present, but Baker Hughes is the name that institutional analysts are already examining. The more compelling capital allocation opportunity, the one where the potential return relative to current valuation is most asymmetric, is in the smaller, less visible players in the same ecosystem. Companies providing temporary site infrastructure for large-scale energy and construction projects, for example, are seeing institutional accumulation that is not yet reflected in mainstream coverage or analyst consensus. 80% institutional ownership, strong buy consensus from the analysts who do cover them, and a technical pattern, stocks that have been consolidating sideways for several months, testing the same resistance level repeatedly that is consistent with the kind of base building that precedes a directional breakout. This is where I need to explain something that most retail investors find deeply counterintuitive and that separates institutional capital allocation from retail behavior in a specific and important way. Institutions do not purchase stocks at their lowest point. They buy stocks as they are breaking out of consolidation, as they are exceeding their recent resistance levels with expanding volume. The reason is probabilistic rather than emotional. A stock that breaks above a resistance level with institutional volume behind it has demonstrated that the buyers are stronger than the sellers at that price level. That demonstration is evidence of a directional shift in capital flow that did not exist below that level. Buying a stock that is declining or that has been moving sideways for months without a breakout requires predicting a reversal without evidence. Buying a stock on a breakout with volume confirmation requires only recognizing a pattern that is already in motion and acting on it before the retail crowd identifies the same signal several weeks later. The specific breakout levels I am monitoring in the energy infrastructure space are in the range where these names have been testing resistance for the past several months. When those levels are exceeded, specifically when the price closes above the recent consolidation high with volume meaningfully above the 20-day average, the setup I have been describing becomes active, not before. Now, let me turn to the second sector because this is the one I believe carries the most asymmetric opportunity relative to how widely it is currently understood critical minerals. I want to pause on why this sector is almost entirely absent from mainstream financial coverage because the absence itself is analytically important. The sectors that are most widely covered by financial media are by definition the sectors that have already attracted significant retail attention. That attention has typically already moved prices to reflect the obvious thesis. The opportunity in well-covered sectors is marginal because the marginal investor, the one who will provide the next increment of demand, already knows about them. The opportunity in undercovered sectors exists precisely because the marginal institutional investor is just beginning to discover them. Here is the structural reality that makes critical minerals one of the most important sector allocations of the next several years. The global energy transition, electrification of transportation, deployment of renewable energy, modernization of power grids requires physical materials at a scale that current supply chains cannot meet. Lithium demand is growing at approximately 25% annually. Copper demand from EV and grid applications is expanding faster than the mining industry can currently grow supply. Uranium demand from nuclear power, which is experiencing a genuine renaissance driven by the AI data center power crisis, European energy security concerns, and the simple physics that nuclear is the only baseload power source that can replace fossil fuels at grid scale, is growing at a pace the current production base cannot satisfy. And the defense dimension adds a layer of demand that most commodity analysts are not adequately modeling. Advanced defense systems, the AI-driven, electronically sophisticated weapons platforms that define next-generation military capability, require rare earth elements and specialized minerals that are currently produced predominantly by China. The United States government has explicitly identified this supply chain dependency as a strategic vulnerability and has mobilized $30 billion in financing to accelerate domestic critical mineral production. That demand is not market-driven. It is policy-mandated and multi-year. The companies positioned at the intersection of these demand streams are in a situation that I find structurally reminiscent of energy infrastructure companies in 2020, before the energy security thesis became apparent to everyone. Their earnings outlook is improving simultaneously from multiple independent demand sources. Their valuations still reflect the historical perception of them as small, volatile, illiquid mining stocks. And the capital flow data shows institutional accumulation beginning quietly at levels that have not yet attracted mainstream attention. The three specific names, SQM, Sociedad Química y Minera de Chile, is one of the world's largest lithium producers, actively expanding production capacity in Australia and deepening its partnership with Chile's state-owned mining company. It is the infrastructure play on the electrification thesis. UEC Uranium Energy Corp has just brought online the first new U.S. uranium production facility in over a decade. It is the only American company with 2 active uranium mining operations, processing capacity of 4 million pounds per year, and direct alignment with the U.S. government's strategic interest in domestic uranium supply independence. AI data centers are increasingly being powered by nuclear. European nations that decommissioned nuclear capacity are restarting it. The demand is policy-driven and structural. And CMP, a rare earth and minerals company approaching a technical breakout that, based on the volume pattern and the institutional positioning data, suggests the accumulation phase is reaching its completion. This is where the mid-video reset matters, because I want to reframe something significant before I close. Everything I have described so far is a structural argument, a case built on macro forces, capital flow patterns, and fundamental earnings trajectories. But structure is not sufficient on its own. The structure tells you where the opportunity is. The risk management framework determines whether you actually capture it or whether you experience the structure correctly and still lose money because you sized the position incorrectly, entered at the wrong moment, or exited at the wrong time. The single most common error I observe is position sizing. Investors who correctly identify a structural opportunity concentrate too heavily in it, driven by conviction, by the compelling nature of the thesis, by the frustration of watching from the sidelines while prices move. They transform a structural allocation into a concentrated bet. And when the inevitable volatility arrives, because every multi-year structural move includes significant drawdowns along the way, as gold's 47% decline in 1974 to 1976 demonstrated, even in the middle of the greatest gold bull market of the 20th century, they are forced to exit at exactly the wrong moment because their position is too large to hold through the turbulence. The discipline that separates the investors who capture structural moves from those who identify them correctly but fail to profit from them is not analytical sophistication. It is position sizing and entry discipline. Maximum risk on any single position calibrated to what you can lose without being forced to exit by emotion or financial necessity. Entry only on technical confirmation, on the evidence that institutional buying is active, not on the anticipation that it will become active, and patience to hold through the volatility that every structural move generates because the structure does not resolve in a straight line. The stocks I have described, Baker Hughes, SQM, UEC, and the smaller energy infrastructure names I mentioned are not trades. They are positions in structural trends that are in their early stages. The energy security investment cycle has years of capital expenditure ahead of it. The critical minerals demand surge from electrification, AI infrastructure, and defense applications will compound for a decade. The investors who enter these positions at current levels, size them appropriately, and hold them through the volatility of a multi-year structural move are the ones who will look back at 2026 as the year the opportunity was apparent in retrospect and invisible to most people in real time. The S&P 500 is 40% concentrated in 10 companies whose valuations were constructed for a zero interest rate, low inflation, globalized supply chain world that no longer exists. The capital that has been flowing mechanically into those companies through passive index investing will at some point face a macro environment that is structurally hostile to them and will rotate. The question is not whether that rotation will happen. The question is whether you are positioned before it becomes visible or after the money is already moving. The only thing that changes between now and when this becomes obvious is the